Welcome to another edition of Perspectives. My name is Rob Pizzichetta, founder of Mont Wealth, and today we are re-chatting with Omar Khan, Head of Capital Market at Alceon. Welcome, Omar.
Thanks, Bob. I was going to say thanks, Bob. Thanks for Rob. Good to be here again and good to be chatting with you, mate.
Pleasure. Now, last time we actually recorded a podcast was over 12 months ago. I think it was episode 19, and we're quickly approaching number 80. Funnily enough, it's gone quick. Back then, we were looking at a declining rate environment in Australia and an improving economic backdrop, and how funny and quickly things have changed. But today we'll discuss the ASIC review, findings and outcomes for private credit in Australia, the macroeconomic backdrop and lending landscape, and how does Alceon lend to borrowers, ensuring that there are safeguards and capital protection for investors. But before we get started, the general advice disclaimer. Anything we discuss today is general advice only. Anyone acting on that advice without written and agreed consent does so entirely at their risk. Now, Omar, we know that ASIC has done a review on private credit in Australia and scrutinised it. Is that valid? Is it required, and why?
Thanks, Rob. And look, I think that's a good question, and I'm sure many of your listeners have read about this. It has been spoken about and published across all the major newspapers. I think the simple truth is the market has grown significantly. And I think at last count, some of the reports I've read, it's circa $200 billion. In most other markets, institutional capital has played a big role but probably the difference in Australia is that wholesale family office capital, that's where private credit started and continues to play a bigger role. There are a lot of, just due to the opportunity and size, there are a lot of new managers in this segment. And it's probably fair to say some are also relatively small. In the Australian context, though, I think it's less about the asset class, but more about the practices perhaps that have crept in. So it's not so much about private credit, it's how those managers run their firms and how they manage disclosure and fees and things like that. And then, Rob, I know you've read the reports. I think ASIC focus more on consistent or inconsistent, rather, disclosure structures, governance issues in some corners of the market, not all, some corners of the market. And so that's for the whole industry, as there are many managers, I think a consistent approach, a more transparent approach can only be a good thing. So from our perspective, we encourage it. And I think there's always a good balance to be struck, but I think if investors are receiving a more consistent form of update, disclosure, and also transparency on those funds are managed, we certainly think that's a good thing for investors and the industry.
Yeah, okay. Now, they've come out with 10 principles across multiple sectors or categories. Which do you think are the most effective, and how many of these does Alceon already practice?
Yeah, the principles are certainly broad, right? Everything from stewardship, organizational capacity, governance, fees, conflicts, evaluations, liquidity. So it's pretty broad, right? I think but if things like transparency and governance are very overarching, and I think if you get those right, especially on how you communicate on the underlying portfolio, alongside governance, matters like conflicts of interest and managers and board trustees should be working to manage and safeguard capital. So if you have those elements built into your process, I think that's really important for investors. And as Rob, the fund you're invested in has an independent trustee, would provide very detailed reports each month and quarter, and then a quarterly webinar. And I know you spoke about your podcast. We've been running quarterly updates for 7 years. And so from our perspective, I think, again, we're super glad ASIC has highlighted some of these issues because they're important, they're relevant, and by and large have always been included in Alceon's approach to managing private credit.
Yeah, I must give you guys credit. The quarterly webinars that I dial into, actually, you've got one coming up, which I've registered for. It highlights the transparency that you guys provide and also the monthly reports and also the detail within those monthly reports around provisioning and exposures and even the duration of loans, which gives us comfort in when and how we invest in your fund. So thank you for that. Now, ASIC Commissioner Simone Constant has said that difference does not defend against market stress, but standards do. Do you believe the industry has kept up, or have we grown too fast?
Yeah, good question. We spoke about this briefly before we started recording the podcast. The Australian market does genuinely have structural differences relative to other private credit markets in the US or Europe. We're more heavily weighted towards real asset backed lending, construction and property compared to the corporate credit folk in the US and Europe. But I also agree that the structural differences aren't necessarily the permanent shield. So the standards probably have been a bit uneven. There are managers in this market who have been operating to a genuinely high standard, to a real good institutional quality for a long time. And there are probably those that have probably grown up very quickly, attracted capital on the back of the strong macro tailwind we had in Australia for a long time, and haven't built the governance and probably the risk infrastructure to match that. And I think, as is clear in some of those reports and some of the meetings we've had in industry, ASIC's been pretty blunt where they feel the voluntary improvement has been a bit slow. And this framework will hopefully provide everyone in the industry, whether the small new managers to the top end, a consistent framework on standardizing those processes and approaches.
Okay. And ASIC's also come out recently and spoken about valuations, mark to market, the valuation as at 30 June. How worried should we be as investors across the industry?
So when we talk about private credit, what are you lending against? And there's often a bit of confusion about this, especially when it comes to real estate credit, because the valuation of the underlying security, and there's obviously a well-structured governed process in relation to that. And then there is the valuation of the securities or the units that the investors hold in the fund. And so both are a little bit different. And so from perspective, we manage, we report the funds or the loan at par at the end of every month and add to that the accrued interest. And whatever that accrued interest might be, we'll receive interest at the end of that relevant month. And I think the question around how widely spread or how consistent everyone across the industry is about reporting defaults and managing those is probably a little bit unclear. I think you've seen, and I think you just spoke to before, from an Alceon standpoint, we're trying to or have established a really transparent reporting framework. So investors are aware and have been communicated well in advance where issues arise in loans. Then probably it's relevant to know that issues in private credit, there'll always be issues. But what are those issues? Is it a breach of a minor term in the facility agreement? Or is it a material breach? What do they look like? And how do we manage those? And I think that latter part is how do we manage issues and how do we communicate those? I think that's I've also mentioned it, but I feel that's the most important part. And as long as managers are doing that, then investors should be well aware and across some of those issues as they might arise.
Yep, no shocks there. You do communicate that on your web. So let's move on to the macro backdrop, because obviously the RBA has hiked 3 times since Christmas or thereabouts. We've got the government that's announced this new tax policy, which is concerning for a lot of people and potentially in the housing market. We've just received Labor's data saying that jobs were added in May, unemployment's at 4.4, so semi-resilient labour market. So how does this backdrop change how you structure and price a loan?
Yeah, good question, Rob. Now, real estate is a very localized asset. And at Alceon, we're bottom-up investors. And of course, the top-down economic context is important to that. But we're looking at each loan. This is in the quality of the sponsor, the asset security, and execution capabilities of the sponsor and builder. And the builder, obviously, we're relevant. And then you asked about pricing. On pricing, the demand and supply of a capital is as relevant to pricing as base rates often. And that's why our preferred approach generally is to have strong bilateral relationships where the sponsor values our relationship, our value add. Price is important, but we're not trying to be the cheapest capital option in the market. And consequently, that also means we're not trying to be the largest. And we've observed a material increase in the supply of capital over calendar year 2025, and that competed down prices and margins. But our experience from early 2026 is that there are fewer active players, which could be for a variety of reasons, whether that they're managing their own portfolio, or they're not originating, or their funds aren't growing. But our view is that might allow for margins to expand slightly. You've already noted that with three rate increases, So that obviously increases the gross lending rate too, because the majority of the portfolio is structured on a variable rate basis.
Okay. There's always a theory of bad deals are signed in really good economic times. So if you go back 2 years and have a look at some of the deals that were signed, as you said, the macro backdrop was really good. And you always start to see some of these concerns around how aggressive were these deals done, how competitive was the market. Now that people have stepped away from competing and lending money out, you're signing deals on your terms. Is that a truer word?
Yeah, so I'd argue that we're always lending on our terms because growth and size isn't a driving factor for Alceon, where you'll see across our history that we've been very happy to return capital to investors where we haven't been lending, or we're happy to step out of the market for periods of time where we don't believe the risk return on-off meets our requirements or hurdles. On your question around best deals written in bad markets, I think really, again, it depends. If you think about it, when we're lending, we're primarily lending at a fixed price return or a variable return, but there's limited upside. And so from our perspective, we're originating at the security level, at the loan level. So we're not like an equity investor who might be looking to negotiate a distressed price for whatever asset that they might be acquiring.
The way that you look at each sponsor, each opportunity individually. So it's not necessarily about a bad loan. It's you're trying to focus on good loans all the time.
Yeah, and growth just isn't a factor for us. If you look at the last 9 months, we've only originated $500 million in loans. We're happy to just sit it out.
Yeah, okay. And talking about sitting it out, does that just mean you're sitting on more cash as a result?
Yeah, so because we have multiple buckets of capital that we manage, some is from syndicates, some are from institutional SMAs, some are open-ended funds, we may return some of that syndicated capital back to investors and keep more capital working within the open-ended vehicle. So that allows us, that gives us that flexibility. So in some years, we might be returning $400-500 million to investors. That's a way of sitting out because we're not going originating more loans, calling that capital back.
Yep. So I've recently had a look at your last probably 6 or so months. The performance monthly returns or distributions back to investors has been hovering around 60 basis points or 70 basis points. So if I look back over history, that's relatively low. Does that mean that you are looking at deals that are potentially lower quality and competing at lower rates? Or does that also mean that you are sitting on more cash? How can you explain that to investors?
Yeah, good question, Rob. So Bruce noted earlier, certainly over CY in 2025, rates were competed down, but also there's also a period of where the RBA cash rate came down. But it's probably important to note that historically, our cash rate targets been probably between 5 and 10%, but more recently, we've actively held more cash in the 10 to 15% range, and that has resulted in some cash drag. And this was in a very intentional decision by the team owing to global uncertainty, given the issues in the Middle East, but also relating to some private credit funds in the US. I should note though, those funds are a lot more tech software focused as opposed to in Australia. But we wanted to be prudent, conservative, and ensure we're well placed to protect fund capital if anything like that occurred domestically. So that's not the only factor, but that's a factor in why those returns have compressed over calendar years 25.
Okay. And so some of that 10 to 15% cash, is that being deployed now or is it still sitting around that range?
Some of it has been deployed, and I should probably note now our origination pipeline is actually very full. It's actually well in excess of the capital the fund is holding. But I guess we're cautiously deploying additional capital into new transactions. Again, going to renoting the points I made earlier, which is around that bottom-up analysis on every deal. Again, real estate, very focused, very localized, which market, which sponsor, and what the product is for that market.
Understood. And that cash that sits there, is that generating a term deposit kind of return?
Point, and that's a really important point because, yes, generally cash at bank is held at an actual term deposit and earning a little bit above cash rate.
Got it. And given you were saying as well that the RBA is repriced, are we expecting also to see higher distributions in the coming months as a result of the back book being repriced higher as well?
Yes. So because the majority of the loans are variable, we'll see some appreciation in those, right? Positive impact on those rates. And then of course, subject to cash trade, there should be that return through to investors.
Great. All right. So let's looking at some of the more recent deals that you've done then. Give us a sense of how you've been pricing them, what kind of terms, how's it changed from say 12 months ago to today? Is it more of an LVR? Is it more of a pre-sale? How does it look?
Yeah. So I think more recently, just similar to the point I noted about the global issues, we have been worried a little bit about construction price inflation. So that coupled with fewer competitors being in the market has allowed us to look at more residual stock transactions or land transactions or industrial data center style transactions. So adjacencies where we've had the opportunity to deploy capital. So still very active, but how do we take the construction risk equation out of those transactions? And that's probably been our focus. That's not to say we're not looking at construction at all, but on a very situational basis.
So how do you price construction risk?
We're not pricing construction risk, but we're trying to get confidence in the construction pricing being put forward and the ability of the sponsor and the project to withstand any inflation construction price increases should that occur, and how would the sponsor manage that issue if that were to occur. And then our confidence is less about pricing, but more about, are we willing to originate that or not? If we're not sufficiently confident that the sponsor has the capacity to manage that, or the sponsor has sufficiently structured their project to be able to withstand those increases if they were to occur.
Yeah.
I should probably note that though that is a risk, and that's a risk that many in the market have spoken about, in the projects that we are involved in, we haven't necessarily seen a lot of that construction inflation come through to bear. So we're still actively diligencing it and making sure we're across it, but we're not seeing the extent of what the market had forecasted actually coming through to those transactions.
Understood. Now, in your May report that you've just released, you've got key metrics, weighted peak loan to value ratio of around 64, 65%, which sounds relatively low and protecting investors. The interesting point, though, was the average duration of 6.9 months, so 7 months. So what does that actually mean?
That is at a portfolio level. So within that would be loans that are 1 or 2 months in remaining duration. Of course, loans 15 or 18 months in relation to lower loans that have been recently originated. But as we had been less active in deployment, last 6 to 9 months, that has resulted in the portfolio duration coming down. If you recall, historically, that's probably hovered in that sort of 9 to 12 month range.
Yep.
And that, in many ways, is a very attractive part of real estate credit because it tends to be short duration, 12 to 18 months generally. And so there's a real self-generating liquidity that comes as a key feature of this asset class. And I think to a large extent why also it has been so attractive to many managers, but also investors.
Yeah, that also gives investor confidence that you actually are very disciplined in your approach. You've clearly taken much more defensive strategy over the last 12 to 18 months, and hence why the duration is only 7 months at the moment versus long-term average of 9 to 12. Now, let's talk about when something goes wrong. What does Alceon do? And give us some examples, please.
Yeah, good question, Rob. So I'll make some philosophical points to start with. So everyone in our real estate team has deep real estate expertise. This is a really important philosophical point for us because we have a cradle to grave approach. So the team that originates the deal also manages it. And if a workout is required, that means, for example, if there's a breach or the loan goes into default for whatever reason, that same very team leads the workout process as well. And then in addition to that, we maintain proprietary deep real estate execution expertise, everything from development management to construction expertise. And that sits on top of that origination team to support as and when required. From a practical standpoint, though, there's a traffic light system that tracks and manages every loan on a monthly basis, and a report then goes to national real estate team, but of course, a head of risk and Alceon investment committee based on a very structured governance reporting framework. But that reporting framework also triggers reporting to externally to our investors and trustees or trustee boards where relevant. And that's why when we spoke about the ASIC framework and guidelines early in the conversation, that framework predated that, and that was ensured that we've always been very transparent with investors and very early on where and how issues might arise in loans. And our view is, the transactions will always be, there might be delays, whether that's due to the fault of the sponsor or not, but a whole suite of reasons can cause that. What's important is that we're actively involved in managing those assets and then ensuring that risk, whatever that risk might be, is correctly managed and reported within Alceon, but of course, back to investors. And it can be anything from delay in sales rates, weather-related delays, or as we were speaking about, cost inflation, which might impact the project negatively. And in some of those instances, we might require the sponsor to add or tip in more equity or find other ways to provide Alceon or the fund more additional security. Or where sales are slow, we might find ways to structure incentives for the sponsor to accelerate and be more focused on those sales rates to ensure that the project and the program completes on time. Because of that deep execution expertise, we're very much in there alongside them to ensure that we manage these issues as and when they might arise.
Yeah, got it. So the key here is then defaults are going to happen. They're going to occur, aren't they? So it just comes down to how you as a team can manage those defaults to get investor capital back or as much as possible, and then continue to pay that distribution back to investors as well.
Yeah, that's right. And because I think when it comes to credit, many people think of default as simply just non-payment, whereas often the default isn't related to non-payment. Often the default is related to a breach in the term of the facility agreement, which might be related to timing, which might be related, as I said, sales velocity. So it's how do we actively manage that with the sponsor to protect capital?
Understood. All right, let's wrap it up here, Omar, because we've taken plenty of your time. Let's talk about the outlook. We've discussed ASIC and its standards and reviews. We've spoken about you identifying quality deals and sponsors. And can you give investors some confidence that the next 12, 24 months, putting money into Alceon should be able to preserve capital and then generate income as well?
So I think for the second half of this year, if I can say, I'd say we're probably cautiously constructive in our outlook. The structural undersupply of housing hasn't changed. And all the government changes in now are unlikely to make any material difference, as you know too well, Rob, to that supply story. Any slowdown in the market is likely to exacerbate that supply story. Pressure on rents upwards. All of the loans in the fund are secured by underlying real estate on a first mortgage basis, and that hasn't changed. And as you noted a number of times, conservatively at 65% at the time of origination. The majority of the fund's loans are structured on a variable basis. So as rates increase, we should see that reflected in those loans and consequently, again, subject to cash drain, a benefit to the fund. Those key things remain constant and haven't changed in the almost 7 years that there's been funds been running and a strategy going forward. And that's the core. And it's a simple fund, but that's fundamentally core to a strategy.
Got it. Love it. That's the title right there. Private Credit Australia from Alceon, cautiously constructive. Omar Khan, thanks so much for your time.
Thanks, Rob. Always really great to chat to you.
Cheers.